Good evening, ladies and gentlemen. My name is Alan Brugler. I'm president of Brugler Marketing Management. We're based in Omaha, Nebraska. We work with clients around the United States and in other parts of the world too. This is part 4 of our introductory series on marketing. We talked about basic marketing skills. We talked about cash only marketing, no futures or options. We talked about hedging concepts in session 3. Tonight we're going to get a little further into things with some technical and some simple explanations of option strategies and why they might be appropriate for your marketing toolbox. At this point, I'm going to close off my camera, hand over the presenter and the mic to Ryan Nielsen, and we'll get on with the show.
Good evening, everybody. My name is Ryan, as Alan introduced me. I'm excited to talk a little bit about options tonight. As a forewarning, some of these slides might get a little complicated, so if you guys have any questions, you can just type them in the chat box. Of course, you can always email us or call us. Our numbers are at the end of the presentation, and you can ask specific questions via email or phone call. I'm joined with Austin.
How's it going, ladies and gentlemen? Austin Schroeder here. So, with Ryan, I've been with Alan for 5 years, and excited to spread some of my knowledge tonight, but Ryan's going to get things started off for you, so I'll let him have control here.
All righty, and with that, we'll get started right here right quick. First things first, a quick NFA disclaimer. There's a substantial risk of loss in futures and options trading. Such trading is not appropriate for all individuals or entities, and past performance is not necessarily indicative of future results. This presentation is not meant to be seen as an endorsement of futures and options trading versus other hedging and marketing techniques. With that said, we're going to go ahead and explain how options can help. There we go. So what are options? Options are derivatives of futures contracts, okay? Basically, they're the right but not obligation to trade a futures contract at a designated price point and during a designated time. One thing to note about the designated time is there are European style options and American style options. We won't get too into the details there. Essentially, the difference being that American options can be called against early. They don't necessarily need to wait until the expiration date. That's the designated time. American stocks on the New York Stock Exchange, for example, grains and livestock are all American style options. But because of the right but not obligation, that makes options one directional. Okay, and how does one directionality help you in terms of hedging? Well, for a long put, for example, that can protect you to the downside but leave the upside open. So what are the two types of options? I already mentioned put. The other one is a call. A call is the option but not obligation to buy. A put is the option but not obligation to sell. And again, that comes with a set price and a set date. And that set price at which you have the option to buy or sell is known as the strike price. And that set date is known as the expiration date. This is what calls and puts look like. If you ever hear anybody talking about the hockey stick graph, this is what they're talking about. I'm going to actually take my pen here and I can explain it a little bit better for you. The y-axis here is your profit or your loss of the options position. Okay, and the x-axis is the underlying. All right, so the x here, that's the strike price I mentioned earlier. That is at the price you have the option to buy or sell at. Okay, so if the underlying gains in value, it moves rightward, right? And if it goes down in value, it moves leftward. Okay, so a put being the right to sell means that if the price goes down, that right to sell at a price above where you're at is worth more. That's the upside potential for options. Of course, the downside is limited, the one directional nature. If the underlying goes against what you thought, in other words, for a put, if it goes higher, you're only out what you paid in the premium. Okay, and that differs from a short futures, which for example might look something like this. Whereas whatever you bought or sold that futures contract at, if price goes for you, that's all profit. And if price goes against you, that's all loss against it. And of course, futures can still be used as hedging because you'll have the cash side to offset it. But that's how puts and calls differ from the actual futures position. Okay, and up here we have the long put. Down here we have the short put. Likewise for the call, this is the option to buy. If you're long a call, then that's the option to buy. We'll actually explain this a little bit later on a couple slides. A short call flips that. You can see how it's the same hockey stick, it's just flipped in reverse. Likewise with put, it's the same hockey stick, just flipped in reverse. And a put versus a call is the same hockey stick, it's just flipped across the y-axis as opposed to the x. But we'll actually cover that here in a couple slides. There we go. All right, so how can you use options for marketing and for hedging? That's kind of the title of the slide is how are these useful for you? So let's compare 3 scenarios. All right, so say person A is a cash only guy, right? And obviously they have the option to forward contract as well, but for right now we're going to say they lock the bin door and they're just waiting until May to sell their corn. Futures, on the other hand, if corn is say at 340, this is a hypothetical example, obviously corn's in the 580s, 590s range right now, but let's say it's at 340 hypothetically. A futures seller can sell a futures contract for May delivery and lock in that 340. A put option, on the other hand, might be something like, I'll pay you 17 cents for the opportunity to sell you corn at 340, even if corn futures are 290 by then. All right, so maybe you're thinking, why would I pay 17 cents for that? And the reason you do that is the one directionality again. All right, so let's recall our choices here. Let's say it starts at 340 and corn rallies to 425. All right, so that cash seller, he opens his bin door, he unlocks it, he sells at 425 minus basis considerations. That futures seller, he already locked in his price at 340, assuming he held it the whole time till expiration. He can either deliver on that contract at 340, cash it out at the loss to offset the cash gain, and he's basically out the difference there minus his basis. But the put holder, he gets to sell at 425 as well, because that's what the cash market is at. He's still out that 17 cent premium because that's what he paid for the put option, which makes his overall cash grain position, his cash price at 408 minus the basis, of course. Okay, and if we compare that to if the market goes down, let's say corn fades to 315. Cash seller, again, he takes that at spot. The futures hedger got 340 because he locked that in. But the put holder, again, he gets the 340 price, okay? But he also paid that 17 cent. So his overall net position is his overall net price is 323. That's basically the 340 minus that 17 cent premium. So essentially the way the one directional risk works, if you think, why would I pay that 17 cents? You can think of, if everything else is held constant, that's what ceteris paribus means. It's a Latin phrase, so it translates to all else constant. You can think of an options hedge as a selling price between what a futures hedge would have been and a wait and see cash position. Okay, in the sense that if you buy a put, and you're right in the sense that market goes down, you're not going to be as, the benefit from that put position will not be as beneficial as from a futures hedge because you had to pay for the premium. But if you're wrong, you're only out the premium and you still get the cash direction. So it'll basically be between the cash wait and see and the futures hedge based on what that premium was. Which brings us to our next slide. Where did we get that 17 cent number from? You heard me mention already, that's known as the premium. Okay, and the options premium, that 17 cents or whatever the market's at, is decided by 2 factors. Those 2 factors are how close that option is to what the underlying is trading at, how close the strike price is to the market. That's known as intrinsic value. It's also made up by extrinsic value, and that's what the possibility of future prices could be. And to clear it up maybe a little bit better, Here's some pretty complicated equations, but basically think of intrinsic value. That's your strike price here, S, and your strike price is X, and the underlying is S. So for a call, that's C. Here's your underlying price and some other stuff minus the strike price. Okay, that's intrinsic value. For the put, it's the other way around. You have your strike price there and some other stuff minus the underlying and some other stuff. Okay, and notice a call is basically the same equation, that's supposed to be an arrow, as the put, just reverse. Okay, the equations flips. Now what this other stuff is that I just mentioned, and Austin will actually get into more detail here in a minute, this other stuff is the extrinsic value. And that extrinsic value is made up of a bunch of moving pieces, and like I mentioned, Austin can kind of elaborate more here in a minute, but those moving pieces are what determine the extrinsic value of the option. The intrinsic value is how close the option is to the market, and extrinsic is some moving pieces there. But fortunately, if I go back to that equation, you don't have to memorize this or even try and calculate it. You can. There are computers out there that do it for you and algorithms that do it for you. But they also have a market, okay? And if you believe in efficient market theorem, basically means that all of that stuff is already built into the price, and whatever the price is, it contains all of that information already. Okay, so, and as options are traded, you can buy or sell them. All right, and if you open your position by buying it, then just like in futures, you're long. And if you open it by selling it, then just like in futures, you are short. So you can have a short call, a short put, long call, long put as your hedge. The one thing to note is if you refer back to a couple slides back here, just real quickly, notice how they flip, right? The long call and the short call, how they flip. Go back to where we were. That basically means your long put, if you remember the 340 example, is converted to a short futures position. However, the short put flips it, so it would actually be a long futures position at 340. Likewise with the call, if you're long a call and it's in the money at expiration, then it'll be a long futures. However, if you're a short call and it's in the money at expiration, then you're going to be short futures at that strike price. Now, selling options, that's actually what this James Cordier comes into play. That's who this guy is. Selling options can be very, very, very risky if you do so naked. And naked basically means you don't have the physical to back it up. In other words, you could buy a put and sell one below it. That's not naked because it's covered. Or if you sell a call against grain that you actually have, again, that's not naked because you actually have the grain to cover it. But if you sell naked options, it can be very risky. And James Cordier can tell you firsthand, he lost a lot of money, and he comes from optionssellersonly.com. All right, so what does in the money actually mean? Options are the right to buy or sell futures at a strike price, but not the obligation to, okay? And what that means is you can actually close your option position before that expiration date. Okay, and if you do so, then you can just consider it a trade. You might buy low and sell high, or sell high and buy back low. But if you do hold it until expiration, in the money options, that's what ITM means, are converted into their corresponding futures position. So like a long put, for example, would be a short futures position if they expire in the money, and out of the money options expire worthless. All right, so to kind of illustrate what that looks like, here's an options chain for March corn. Okay, in the strike column, you've heard me refer to the strike price a number of times already. The strike price, this is the strike column. It shows all of the various strike prices for that March corn derivatives. All right, if we look at the $6 strike price, for example, right here, a $6 put is in the money because the market is at $5.90. Okay, so if it were to expire today, the $6 put would be converted into a short futures position if you were a long put at $6, you would be short futures at $6. However, if you were in the same $6 strike but on a call, say you had a long $6 call and it expired today, that would be out of the money. That call would expire worthless. That's how the in the money, at the money, out of the money works. Another thing to note, and we'll come back to a few more options chains and the various things you can look at. But this last column is basically those premiums. That's how much the option costs. If you notice, so if you notice here, an at the money call is worth 23 cents. Okay, and as you go further away, remember call is the option to buy. So as you go further away from the strike price, down here, say 635 call is only worth 8 3/4 cents. Okay, and it goes all the way down to 6 1/4 at 650. But in the money calls, as basically as you're below the market at 530, are worth a lot more. That's 63. Okay, and same thing for puts. If you're way below the market, if the market's at 590 and your puts at 530, that's only worth 3.5 cents. Likewise, if you're closer to the money, it's the same 23 cents, and down all the way at 650, that's the right to sell corn at 650 is worth 62 cents if the market's at 590. This particular options chain snippet was taken on December 10th, so the numbers have changed a little bit since then. But if you refer back to the $6 strike, recall earlier I mentioned that grain futures and options are American style. Basically, that means you could call this $6 put because it's in the money. You could call it in right now if you wanted, and you'd have a short futures position at $6, but you wouldn't necessarily do that because if you did that, you'd have short futures at 6. You could sell them back at the market price 590. That'd net you a 10-cent profit, but the put itself is worth 29 cents. So while American style allows for that, you don't actually see it. It's not as common because there's other, if you recall, the other stuff that I mentioned keeps that option above that's the extrinsic value portion, right? The intrinsic value would be the 10 cents from the $6 to the 590, but the extrinsic value makes it not necessarily worth it to call it early. And then moving ahead into options mechanics. So far, I touched on it a little bit on the last slide, but so far, we've mostly looked at buying, say, for example, you bought a put and you held it till expiration. Okay, options, just like the corn prices move every day, option prices also move every day. Okay, and as the futures are moving, options also change in value because if the price is moving away from the strike price, that's the intrinsic value getting, further away from you, that's worth less intrinsically. But also there's other moving pieces, which Austin's actually about to get into, and those other moving pieces are also changing. For example, how much time is left until that expiration date comes, or how volatile the market is, etc. That can also change day to day, and it'll also change the premium as it moves. And I think I started to steal a little bit of your thunder, Austin, but if you want to talk about some of that other stuff I touched on and let them know how, I guess, options move and how that premium is figured, I'll pass it on to you.
Yeah, well, thank you, Ryan. And we're going to kind of get into some of this. Just to forewarn you, some of this can be a little bit, I guess, tricky to understand. So don't let it get in over your head. It's kind of just helping you to understand kind of what goes into options and I guess what is driving prices and why, options, let's say back in May, were so ungodly expensive. It'll kind of help you to understand what we're about to talk about, understand the reasonings behind it. Anyway, let's get on with what we're going to talk about. Those are basically called the Greeks. That's where we kind of get some of these things from. It's that equation that Ryan was showing you a few slides ago. This is where those kind of come into play. All right, yeah, so the Greeks here, we got delta, we got gamma, we got theta, vega, and rho. So we're going to kind of briefly talk over these and just explain how they interact with, or options react the way they do. All right, so the first we're going to talk about is delta. So delta basically, as this would say, measures how sensitive an option is to price change, right? So just to kind of give you a good example here, and at the money option, right? So I believe corn futures closed 586 or something today for March. Let's just go to 590, and let's say an at the money put is 590 for March corn. The delta on an at the money put is or an at the money option is typically going to be 0.5, which means for every 1 cent move in the underlying futures contract, which here would be March corn, your option is going to move at a half a cent. So, right, just make it easier. Every 10 cent move in the underlying contract, your option is going to move 5 cents, right? So that's what we mean by delta. It measures how much your option changes versus what the underlying futures contract changes. What we would consider a high delta here is 0.7, right? So that basically means that those are typically deeper in the money, right? So a deeper in the money put right now would be 620, 630, and a in the money call or deeper in the money call would be in the 550, 540 range, right? But anyway, those in the money puts typically have a higher delta, which means as the underlying futures contract moves, they typically will move at a greater pace than what a lower delta would have, right? So a lower delta 0.3 and a 10 cent move would move 3 cents and so on. So we'll kind of look at an option chain here. This is March corn, and I believe it was actually pretty close where we closed the day. But here is what the delta is for calls, and here's the delta for puts. Just to note here, puts have a negative delta, which just think about it in terms of if you're buying a put, you're buying an option to sell, right? Well, if you bought a futures contract, which would be the calls here, if you have the option to buy or go long, you physically have that contract or that paper in hand, right? You bought a futures contract. Well, if you sold one, you essentially have one less, so you have a negative one, right? So that's why these puts always have a negative delta here, right? So delta is higher here, like as we get here in the puts, delta gets a little bit higher as we move down. Let me get as we move down here, you can tell, or move, I guess, higher and to a higher strike price, deeper in the money puts, you get a higher delta, right? Negative 0.84 at a 640 put, right? And then vice versa for calls. As you get deeper in the money, or prices, 520 call has a 0.835 delta, right? So that kind of just shows as you get deeper in the money here, your delta is getting higher, which basically means at on a 10 cent move, if you have a 520 call, you're going to have basically an 8 3/8 cent move on that option, right? So that kind of just explains to you what delta is. It's the rate of change of the option versus the underlying futures contract. All right, and so we're going to get a little bit more on delta. Going back to that example that we had, if you bought a 340 put, right? If you purchased it at the money, so meaning when the May futures were at 340, you bought a 340 put, your delta is typically going to be negative 0.5, right? So that's what your delta is going to be on an at the money put. If corn prices fall to 325, right, you gain 15 cents on the futures position, right? But you don't gain that 15 cents on the option itself. You only gain 8.2. Well, okay, you started at 0.5. Why did you gain more than half of that underlying futures contract, right? So you gained basically 8 1/4 cents on that futures contract. Half of 15 cents is 7.5. Well, as you get further in the money, right, your delta here is now negative 0.6, right? So as you get deeper in the money, your underlying your put is going to gain in value more, right, at a faster rate than it was previously. So that kind of helps explain why you have a 8.25 cent move there in your put value there. So and also, yeah, another example here we want to get across. If you purchase a put at the money with a 0.5 delta, right, you're basically only hedging a half of a contract, right? Because the 0.5 delta basically means you only have half a contract. Okay, so instead of a full contract, you only have one. So typically what we would do in this certain scenario, right, is typically we delta adjust our options. What that means is we basically take the delta right here. So right now it's 0.5, right? So we would want to get to one contract. We want to get to the equivalent of one futures contract, right? So what would that be? That would be 2 option contracts, right? And you can kind of play with delta as you hedge. I mean, if you want, typically, right, if you get to the 325 on the underlying contract, you have now 3,000 bushels hedged essentially on that contract because your delta is 0.6, right? You can play with delta if you want to basically get the equivalent to one futures contract, but typically what this would mean is you would just have, if you get deeper in the money, your option would gain in value more, so you'd be gaining more than if hypothetically you took a futures position. Oops, went too far. All right, now next one we want to kind of explain is gamma. So gamma is basically the change in the delta, right? So gamma shows how sensitive the delta is. Basically, it measures delta, it measures how much the delta moves on a 1% per 1% in price, right? So basically, if you have a higher gamma, it means your delta is getting stronger at a faster rate, right? Lower gamma means your delta is getting stronger, but at a slower rate. So it just kind of explains how fast your delta is moving here. And here we kind of can explain it. Typically, your gamma is going to be strongest here at the money. Let me get a pen here to show you. Right here we have it at the money. Your gamma is going to be 0.0084. You get a little bit further away here. You're in the money, but it's 0.002, and you get a little further out of the money, and it's 0.004005. Right. So when you're closest to at the money, right, your gamma is going to be strongest there. So it's basically your delta, change in the delta, right? So our next one is theta. So when I think of theta, the biggest thing I think of is it starts with a T. What else starts with T? Time. Time is a big thing when you're trying to understand options, right? So we call it, theta is basically the equivalent of time value. As you get closer to expiration, you have a lot more time decay. It just kind of basically, so just to give you a modern or just a current example, you have more time decay, or more time value on a December 2022 option for corn than you would have on a July contract. Or if you just want to say, I want to talk about strictly old crop, right? If you want to buy more time value, you would go with a July put versus a March put, right? Because you have basically another 4 months on there. Basically, theta is the measurement of time. It is, but though it is, as you can see here, it is not linear. So I'll show you the next. Should have a little graph here that shows theta as it's working. Okay, so here is kind of the measurement of theta or time value or whatnot, right? So here's your 180 days out on your expiration to the option. Here's expiration, right? So you can see here till about day 90, your time value or time decay is fairly, I would call it fairly linear here, right? So you get your highest percent. So yeah, this kind of shows your highest percent of options traded have less than 90 days to expiration. So typically, when you're trading options, you're going a little bit closer to the expiration. There's a higher percentage of them. But as you keep going here, it kind of stays linear until about day 60, right? So you're now 120 days into your options expiration, basically 2/3 from where you started here, 2/3 of the time, but you've only decreased your time value by half, right? So that means in the last 60 days or 1/3 of the time, right, you have the other half of your time value is shrinking. So as you get closer to the money, or excuse me, not to the money, as you get closer to the time of expiration, your time value starts to shrink at a more rapid rate, right? So that's definitely something you want to be aware of. Right now, let's say if you buy a July option, it's not going to decrease in value based off time as much as say a March option would. So that's just something to keep in mind there. When you're buying options, a lot of time you're buying time as well. All right, a little bit more on Theta, right? So, or time value, whatever you want to call it. For the Greek term, we call it Theta, right? If you go back to this example we've kind of been referring to, if you buy a 340 March or May put, if you purchased it in December with a negative 0.1 Theta, and then corn, right? Corn falls to 325. It's a 15-cent move. However, you only gained 9 cents on that option. Your time ate away at the value of the option because now you're a lot closer to expiration here. All right. Now the other one that's kind of important here we want to talk about is Vega. Vega is basically, when you think of that, think of volatility, right? So T, think of time. V, think of volatility. Vega, volatility. So basically what we were measuring here is the amount of volatility in the futures or the option itself, right? So typically you have a volatile market. Your option is going to be priced at a higher premium. Good example here was back earlier this spring. Options were very, very, very expensive, and it didn't really have much to do with time. It didn't have much to do with any delta or anything like that. A lot of it had to do with volatility. Volatility played a huge role this past spring when corn was up in the lower 6s and beans were in 14s and etc. We were in extremely volatile time. Beans were swinging 40-50 cents a day. Corn was going 15-20 cents a day on average. There's a lot of uncertainty when you're trying to price into that. So when you have a very volatile market, typically your options are going to be priced higher just because there's a lot of uncertainty. Because if you buy a 590 put and the market's at 590, the next day it could be at 570, 540. There's such a volatile market, you don't know where it's going to be. So the seller is going to be saying, pay up a little bit more for it because, if I sell this and it goes against me, I'm going to be having a margin call, right? So, and finally, the last one we're going to talk about here is Rho. Basically shows interest rates, the interest rates influence, right? It kind of gives you your opportunity cost, right? So there's a little bit of impact here. Options are riskier, bonds are safe, and so on and so forth. So Rho, I don't want to get deep into this one because it just is a little bit harder to explain, but it's just basically your interest rate influence. It kind of just shows that, and so on and so forth, your opportunity cost. Okay, so hey, Ryan, you want to kind of help explain this graph a little bit with me as well here?
This graph is showing at the money puts for the Jan soybean futures contract. And the graph starts on November 1st and goes through today. The actual price for today might not indicate the close. I grabbed this graph a little bit earlier. But these gray bars, as Austin was saying, is the premium for what the at the money put was. Now, obviously, as prices were moving, the at the money put was moving as well. So we grabbed whatever that strike price was to represent what at the money would have been. Okay, and if you compare these gray bars to each other, you can see back here in November, when there was a little more time value in that January soybean futures, there was a little more time. January options just expire on December 23rd. So you are in the last 60 days here. You can see time decay really starts to shrink, especially as you get into some of these bars over here on the right side of the graph. That's showing the time decay, right? So at the money puts back in early November, we're all the way up in the upper 20s to mid 30s cents per contract. But down here, the same at the money put is only in the low teens. Okay, and that's most of that is time decay, but there's also volatility. Now, Austin actually touched on the volatility from the early spring. We have seen volatility come down some since then. However, you can tell during the Thanksgiving break, which I believe actually would have been over here. This was the Thanksgiving break. You can see there was some volatility still in play. So if you take, for example, this is 1250 and this is 1250. With time value, you can see there was only a couple weeks, 2 weeks from November 1st to November 16th. There's only 2 weeks at time value, but the premium shrank a lot. Okay, and that was this volatility here. You see how the distance from the blue dots, from this blue dot to that blue dot, that was the underlying price of the Jan soybean futures. That's a pretty big jump from one day. That's a pretty big jump from one day. That's a really big jump from one day. That's 20 cents from the 16th to the 17th. So a lot of that was volatility, explaining why that bar might have been different than that bar. But again, this graph mostly is just showing the time decay and how the different deltas, of course, the delta would have been the distance. They're all at the money. The options change for soybeans is 10 cents. So even though it's at the money, it might be like 3, 5, or even a penny away from the actual trade price of Jan beans. So the distance there can show delta, and that can show up here in premium value of that put as well. And then if we go to this graph here, this is just showing the same put. So this last one was whatever the at the money was for that day. This is the same 1250 through the same time window. Here's November 1st, this little yellow dot. So if you think here's the 1250, it gets more expensive. Well, that's because it's in the money and it's getting deeper in the money as Jan beans were going down during that time. Okay, so that's why the put was increasing in value. However, you see if you're at the money here, your put was only about, it's on the left side, it was only about 35 cents. If you fast forward all the way to here, now you're at the money, and your same at the money 1250 put is only about 15 cents on this day. That again shows time decay, right? And it's not exactly linear, especially here in the next 10 days. Jan soybean options will expire. Alan, is there anything you want to add?
No, I think you've covered that pretty well. I think we're ready to move on to the next slide here. So just to kind of wrap up this session, this slide is very busy. This is from the CME group, and you do have the capability of downloading this. We have these as a PDF file. We'd be happy to forward one to you if as you're viewing, you'd like to have this full size and in living color. But as we've talked about, you can buy options, you can sell options, you can buy and sell options in combinations, which I'm going to talk about for a minute here, based on what your marketing perceptions are. Again, what we're trying to do with options is just pass price risk to others, but we want to do that in a one-directional fashion. Whereas if we use futures, it's a two-directional, and if we're using cash, we can't pass it on. We're just absorbing that risk until we unload the product. This table actually shows you if you have bullish expectations, that is, you think the market's going to go up, which tools you can use based on what you think the implied volatility is going to do, how active the market's going to be. You have different tools if you have bearish expectations and or if you have market neutral expectations there in the right-hand column where you're really not sure what it's going to do. We can do what's called a short strangle, for example, where we sell an out of the money put, sell an out of the money call. We get a credit for it. We're really betting that it goes nowhere. That's not a hedge. That's not something we would do as our main protection against a cash grain or cash livestock position, but sometimes it does help to bank a little time premium and time decay against what you're going to have to pay for those puts or calls later on. This kind of wraps it up. This is the hockey stick that we've been talking about. This is the profile for a put option. In this case, a soybean March 22 1260 put, which was an at-the-money put at the time. And this is using option view software, but I think this in the next slide will kind of integrate some of the things we've been talking about tonight. There are 3 lines on the graph. The dotted line is the value of that put option today, and then the left and right axis is the underlying futures premium. So you can see it. The futures price goes from 960 on the far left to 1560 on the far right. The green dot is where we were when we entered the position. So obviously you paid good money for that put, and about $1,775 actually for a 5,000 bushel contract. That wasn't at the money put, so they are fairly expensive. So if the market goes nowhere until expiration, then you'll have the solid line. You'll basically lose that $1,775, but initially the option will act like the red dotted line. It will, if the market goes down, that put option will make money right away, and because you're talking the next day or two, you don't have any time decay working against you yet, so it pretty much tracks the market up. And if you get far enough in the money for the put that's going in the negative price direction, it just becomes a straight line function of the price. Conversely, when you go to the right, you've got that $1,775 cost. The put you'll never want to exercise the 1260 put. If beans are 1380, you're going to want to sell cash beans at 1380. But this is also an illustration of the expense. And what we like to do is we know that the futures are only going to go a certain amount of price distance in the time window. We have various statistical tools to tell us that. In Brugler Marketing, we have what we call techno-fundamental forecasts that project the price range for the year based on the underlying fundamentals. We have shorter term models called price and probability forecasts that say historically, if you started here, you're going to trade between X and Y over the next 90 days. So you don't necessarily have to pass all price risk on to others. You need to pass price risk on in a certain time window, a certain price range. So if we can go to the next slide, I still have that same 1260 put, but I've sold a March 1140 put against it. This is what's called a covered right, because the long put makes money and will make money all the way down to the 1140 strike price. The 1140 would lose money if the market dropped below 1140, but the 1260 would make it. So your maximum hedge in this case, if you're buying the put spread to offset a cash grain position, your maximum move here is that $1.20 between 1260 and 1140, and then adjusted for the premiums paid. So what does this, by adding this extra layer of complexity, what does it get us? All right, first of all, by selling the 1140 put, we get a credit. So that means if we didn't need the insurance, if we didn't need the downside price protection, instead of losing $1,775 because beans went to $14 or $13.80, we only lose 1,330 because we still had the loss of the insurance we didn't need, the 1260 put, but we got a credit from the downside insurance that we sold to somebody else that they didn't need. So a bear put spread will reduce your exposure to the upside. And in this case, if you were hedging and you had the underlying cash grain, you would actually gain some ground here. Quite a bit of ground at 1380 or 1440, because now you've reduced your cost of your insurance, but you've gained all of the advance in the underlying cash price. To the downside, it also reduces your cost of your put, improves your profit slope until you get to that 1140. Again, this is not a hedge that'll take you to $8. It cuts out at 1140. We use these because we think that we're not going to get to 1140 probably in that time window, and we don't want to pay for all the premium to zero. We just want to pay insurance for the loss that we expect that we might occur. Just a fine point for you. This is a feature of the software, but it's something you can do. The Greeks that Ryan and Austin explained to you also allow you to calculate reverse the probability of getting to various prices. The purple line that you see right above my mouse here is one standard deviation from the current price. So that in 2/3 of the years, based on the premium that's being paid, that's how far the market thinks you could get at the max. So when we were entering this spread, one standard deviation is 1380 down to about 1155. So 2/3 of the years you wouldn't go below 1155. Now in 1/3 of the two standard deviations, which is the green line, is 95% of all the probabilities. Yes, you could get down below $10 in 1 out of 20 years. You could get down that low, and conversely, you could get above $15. So it's not risk-free. You would have to adjust the position if it starts to go further than that standard deviation. But again, the purpose of these spreads increases the potential gain to the downside because you've got less net premium. It reduces your cost to the upside, again, because you've paid less premium, but it does cap you to the downside by the one that you sold. If we were to make this more elaborate and sell a call as well, what we call three-way, it would also cap you to the upside, but would make the trade almost free for some of the prices in the middle of the standard deviation range. Again, this is part of what you've seen tonight is part of actually a 2-day technical analysis workshop that we conduct here in our office, where we go in greater detail. We have you do practice of many of these different types of hedges, using futures, using cash only, moving basis, option spreads, and so forth. This was just meant to be an introduction, and just like cryptocurrencies, nobody seems to know how they work, but there is an underlying logic and math to them. That's true with options. The CME group says that there's been a tremendous increase in the number of options being used by ag producers here in the United States because they do like this one-directional control. If I own cash grain and I'm a seller of cash grain, my risk is that it goes down on me. I want to keep the positive price risk, the chance it'll go up. I want to keep that and put it in my pocket. I only want to pass the negative price risk on to someone else. That's what options do. All right, so to recap, the marketing session, we were saying you need to identify your inherent risk. Is it up or down? And figure out how to protect your bottom line. In cash sales, you're converting your production into physical dollars, but those are fire and forget. You can't, if you forward contracted, it's extremely expensive to buy your way out of that contract. Basically, have committed, all right, and you have to like the basis and the price when you do it. In hedging, you are separating the futures price and the cash price and the basis. So you're making two decisions, a price decision and basis decision, and you can transfer some of that price risk to others. Options do the same thing, but they do give you one directional control. The trade-off is you do have more complexity and you do have to deal with time decay and volatility. We can go purpose, the goal, the plan, and then options are one of the tools in the plan and executing the plan. Again, Brugler Marketing Management, very happy that you joined us for this webinar series, either live or watching it as videos. We are professional market advisors, have been in this business for quite some time. Ag Market Professionals, our main service. Special research reports is a good enhancement for your own marketing decisions because it gives you some of the statistical backdrop behind these strategies. We also do outlook and training sessions such as the advanced options webinars and workshops. So please call us at the numbers on the left if you have questions about any of the 4 webinars that we presented, or if you're interested in subscribing to one of the advisory and analysis services, or in participating in our workshops. Again, thank you for your attendance this evening. Have a happy holiday, and we wish you all Merry Christmas as well.